Let's get a special market voice. Sukumar Raja, MD and CEO of Asian Equities at Franklin Templeton Investments, joins us right now on the show. Sukumar, good having you. Thanks so much for joining in. A lot of growth problems for the global economy, some challenges as well. Do you see a downside risk on the equity markets, or do you believe that there is a case for an upside risk to the same?
I think there is a very high probability that there's an upside risk to equity markets rather than a downside risk, because the growth problems have been extremely well highlighted. So people know about the various challenges that the global economy is facing. But the point is, equity valuations are very attractive compared to other asset classes. And at some point of time, I think there has to be some sort of shift into equities, in my view. And there is, it could happen sooner than later.
Right. So, Sukumar, is it possible for India to outpace growth estimates suggested by global credit rating agencies and other institutions in light of the current key macroeconomic indicators?
I think it is a possibility. The key is for India to demonstrate that it will continue to be a growth economy and differentiate itself compared to many other economies. Most economies have growth problems because of their linked global trade or aging population and so on. India has some very powerful drivers, very good demographics, good savings rate. So the local demand can continue to grow, can fuel the growth of the economy, provided issues like inflation, excessive deficits, etc., can be put to rest. We have seen some progress in those front, and as long as further progress is made, then I think there's going to be confidence that India is a different story compared to most markets in the world. And if people perceive India to be a different story, I think there's a lot of more money that India can attract.
What about the policy, Sukumar, slated in a few days from now? Do you think that the hawkish stance could continue, or would the RBI change the course?
I think the inflation is headed down. As long as policy measures continue to be reasonable, I think inflation will be on a downward trajectory, and there's a good possibility that the central bank can cut rates. The key is for the government to ensure that there are no more big populist measures in the immediate future that can, drain the resources. So that is the key. So as long as I think the government policy is reasonable, I think there's a very high likelihood that inflation can go back to the acceptable trajectory of 5 to 6%, and there can be rate cuts.
Right. So what level of India's fiscal deficit to GDP would give some comfort to the markets, according to you? And what really is the roadmap which is needed to help achieve the desired levels?
More than an absolute number, what we would like to see is a clear roadmap whereby the fiscal deficit can reduce by 1% a year for the next 2 years, and after that probably might be by a smaller magnitude, but I think a clear roadmap to see a meaningful reduction is important. And for that, I think there has to be some clearer longer-term policy on fuel pricing. I think this is a very good opportunity to drive that, because the global oil prices have reduced and we already increased the local prices. So we need to put a dynamic policy in place whereby the adjustments can happen automatically, and we don't have a situation where suddenly again there's a big shoot up in the subsidies, etc. So similarly on other fronts as well, if you are going to have food security bill, etc., I think there should be a ceiling as to what the government can spend on that. And also things like minimum support prices We can't continuously have double-digit increase in minimum support prices. So I think if these things are, if there's a clearly enunciated policy with regard to these things, then I think there'll be confidence that the fiscal deficit is headed downwards, and that will give a lot of confidence to rating agencies and markets and investors and so on.
With the first phase of reform measures coming in, which other reform announcements are investors more looking out for? What is something that would enthuse you, Sukumar?
Rather than announcing a lot of reforms, I think some of the more serious investors would actually look at the quality of the execution of the already announced reforms. I think that is key. If we are speaking about retail FDI, then probably that has to be taken to logical conclusion. If we are speaking about speed up in project implementation, whatever new setup that has to be put in place to ensure that, we need to put that in place, or a serious proposal put in place. So I think I'm not looking forward to too many announcements, but I think progress on some of the key issues, and as long as there is steady progress, I think the confidence will improve.
Right. So amid the several fully priced stocks in equities, which ones look cheap to you?
The telecom companies have become cheaper. I think there's been more panic or disappointment over the fees that they have to pay to the government. So I think they have become cheaper. So some other infrastructure related or industrial related, some other stocks have become cheaper. There might be some of them who really shouldn't be negatively affected, but have got affected because the overall sentiment on some of these sectors is negative. So these are some of the type of stocks that have got cheaper.
How do you value the PSU banks vis-a-vis the private sector banks? Because there has been a bit of rally that has come into the private banks now, and they are trading at a much more different valuation parameter.
We look at the longer term dynamics. So PSU banks are cheaper compared to the private sector banks. There's no doubt about it. But there are structural issues that the PSU banks have been facing and will probably continue to face. And because of those issues that they are facing, they might continue to lose market share. The quality of their assets continue to be inferior to the well-run private sector banks, and consequently the return on equity that they can generate is also lower, and there's also some concern that the return on equity might dip to much lower levels compared to what we have seen historically. So because of these reasons, while on a price to book or price to earnings basis they might look cheaper, we don't necessarily believe that the state-owned banks carry more value compared to the private sector banks. So in our portfolios we have found more ideas within the private sector banking space than within the state-owned banks.
So what is your view on cement companies, and do you see a lot of value now left in the sector?
When we look at cement companies, we look at what is the valuation, how much are we paying per ton, and we compare that to replacement value. We compare that to what type of operating profits they can make on an average through the cycle, and what multiple we are paying to that profits, and so on. So we have a way of looking at those companies, and today whether we are seeing a lot of value based on our valuation methodology in this cement space, no, not a lot of value. There might be selectively some companies which might present value, but on the whole, we're not really excited about the opportunities there.
Okay, Sukumar, just lastly, I mean, just wondering if the two-wheeler market looks exciting at the current prices, and from the auto pack per se, what is it that you fancy?
Regarding motorcycles and two-wheelers, I think the issue is, there's a structural change in the nature of the industry. The number of players is increasing. So from being a very cozy duopoly, I think it's becoming a oligopoly, and with the more intense competition between players. So I think there is a risk that the margins and return on capital will settle down at a lower level, and also the volume growth for each of the players can be low because the market share is getting distributed. So we have to look at it in that light. We have to model companies based on some of those assumptions. And if we do that, it's not looking exciting at the current prices. Regarding passenger cars, I think we just have one company. Again, that there's an issue about market share and margins there. So considering the risk, again, there doesn't seem to be too much of value within the passenger car space in general. And of course, trucks, etc., are more cyclical in nature. And many of the companies are no longer pure truck manufacturers today.
Okay, Sukumar, pleasure having you on the show. Appreciate you taking the time out and joining in.